Hello, I'm Christopher Davis with Morningstar.ca. As you know, when you invest in a mutual fund, you have to pay several different sorts of expenses. You have to pay the manager that runs the fund. You have to compensate the fund company for administering the fund, for sending you shareholder letters and shareholder reports and things like that. All of these costs are expressed in the management expense ratio, or MER. But what a lot of investors don't know is, as an investor, you're paying more cost than just what's expressed in the MER. Here today to explain what some of these costs are is fund analyst Vishal Mansukhani. Thanks for joining me, Vishal.
Thanks for having me, Chris. And absolutely, apart from the MER, there's also the trading expense ratio, which is a measure of the total brokerage commissions that a fund's trading activity generates.
Yeah, so the TR is kind of like the MER, but for trading commissions.
Exactly, and it's generally higher for funds that have a much higher portfolio turnover than funds that have a low turnover.
And so what's the takeaway for investors? If I'm a fund investor, what sorts of funds should I be worried about where trading costs could be relatively high?
Well, there's many answers to that question. Firstly, a fund that invests, the funds that has a very high turnover strategy will tend to have a high trading expense ratio.
If you do a lot of trading, it's going to cost you more to trade, right?
Exactly. And also, there's another cost which is not seen on any documents. It's called the implicit cost of trading, and that is a result of a negative price impact on a stock, which is caused due to supply and demand forces.
So, just as an example, if you and I go into the market and buy Apple, we pretty much get whatever price is quoted to us by our brokers. But if we're a big fund and putting, hundreds of millions of dollars to work, they may nudge the price of Apple up because they're trying to put a lot of money to work in the stock at one time.
Perhaps. And also, implicit cost has a bigger negative impact on stocks which have a smaller market cap and are not as frequently traded. So if a stock is really small and doesn't trade that much, it will definitely have a really bad negative impact. But maybe a very liquid stock such as Apple or maybe one of the Canadian banks, implicit costs are not a huge concern.
Right. Maybe Apple wasn't the best example, but a really small company, it's sort of like a really large person jumping into a small pool.
Exactly. That's a very good comparison.
So, there are instances actually where the TER, the trading expense ratio, is comparable or rivals the management expense ratio. I don't know if you've come across any examples of this in your research.
Of course, there are quite a few examples, but at this point, off the top of my head, I can think of one fund called the TD Canadian Equity Fund, and the previous manager had a portfolio turnover of 230%.
And so this means they were buying and selling all of the securities in the portfolio twice a year. So
yes,
definitely a happy trading figure.
Yes, and that caused the trading expense ratio of that fund to be almost 50 basis points. The MER of that fund, on the other hand, is a little over 2%. So the trading expense ratio was 1/4 of the MER in that instance.
So the bottom line is the investors weren't paying 2%, which is not cheap. They were actually paying 2.5%, so they were even paying more than they probably thought they were. And so, if the market returns 5% a year, you've just given away half of your returns to expenses.
Exactly. And just another reminder, the trading expense ratio can be found on the MRFPs along with the management expense ratio and also on the fund fact sheets.
And you can find that on most fund company websites, right?
That's right.
Well, thank you very much for your insights, Vishal. I'm Christopher Davis with Morningstar.ca.